Now we'll broaden out our market conversation, get some stock picks that you need to keep your eye on as well. To do that, we'll welcome in Samuel Dyer Bakerly. He's the founder and private wealth advisor at Generation Capital Advisors. Thank you for being with us. I'd love to just get your overall market thoughts right now to start.
Marley, thanks for having me. Yeah, I think overall market thoughts are driven by where we were 3 months ago. If you look back to April, I think everybody thought the world was falling apart. The way we trade was going to be changed forever. Inflation was stickier. And if you look back to today and where we're at now, we have softening inflation. We have certainty around taxes. We've got a consumer that's risen from the ashes, and it looks like that rates are going to be coming down. So our base case is very bullish, underpinned by a strong economy. We're incredibly bullish on U.S. equities and more cautious on intermediate and long-dated fixed income.
So if you're bullish from an investment perspective, where do you see the most opportunity right now?
I think we see the most opportunity in U.S. large cap, high quality names. So we're strategically long the cap weighted indices and tactically trading into the high quality names such as Microsoft, JP Morgan, Walmart, and Amazon. So we think that especially come September, which is the most volatile month in markets, paired with the fact that we've seen this tariff playbook before, right? We just got Japan done, which is a great win. But if you look back to 2018, there's going to be significant volatility getting the bigger, more important deals done. So we're going to be looking to deploy capital into individual names when there's volatility.
So how has some of this macro uncertainty and this volatility with tariffs and the geopolitical issues changed your investment strategy?
I don't think it's changed our strategy too much because we're overweight equities, and we have been for a while, because fixed income isn't giving investors a real return. Our view is that we're willing to trade some standard deviation for a real return for our clients to keep up with purchasing power. So what we're telling our clients is you got to be like a firefighter. You got to be willing to run the building when everyone's running out. And that's exactly what we were doing in April, picking up individual names at huge discounts.
Yeah, I mean, there's certainly a lot of pressure. People feel the pressure to run in when they see others running in, but also we get that fear factor that leaves people on the sidelines. You say you're overweight on equities, and you've mentioned U.S. equities. Do you have anything in international equities? We have seen, a pretty substantial shift as international markets are outperforming ours.
Yeah, boringly enough, we're long the index, SPDW, the SPDR ETF. We believe that we'd rather index equities, international equities, and index emerging, and be slightly active on the U.S. side for names that we can buy and hold for the long term for our clients.
All right. So what are some of those names that you think that you need to buy and hold long term?
Right now, we're overweight versus the benchmark, JP Morgan. This is just a name that I believe everybody should own in their portfolio. First and foremost, you want to be in the biggest and the best. Banking is getting more complex. Dare I mention, stable coins and crypto becoming more democratized after this week. They have the best, in our mind, the best CEO on the street. Additionally, they've grown their dividend 11% annualized over the last 10 years, and only paying about half of that out of free cash flow, and none of that's financed by debt. So JP Morgan isn't going to be the sexiest name in a portfolio, but it's a name you have to own.
And certainly, as we got all the big banks, JP Morgan did really well in their performance. What stood out most to you in their most recent earnings?
Well, I think it just beats across the board. We're most important to us, and what we're actually most excited about is probably what not a lot of people are talking about is the IPO market. It's been essentially closed for the last 5 years. So while consumer banking is one of the most important channels for them, I think that there's going to be a huge opportunity in really a pent-up market, and a market that is really privatized now. Less companies are going public right now. So we think that there's a huge opportunity for that in the future for a lot of these private equity companies to try and monetize their positions.
Very interesting. All right, who else do you have that you plan to hold long term?
Microsoft, I think, is a name, right? Everybody's got to own overweight versus the benchmark. And that may be almost more of a story of Apple than Microsoft right now, to be honest. Apple's almost giving us IBM vibes or tech companies of the early 2000s that just got fat and happy and didn't innovate. They're losing top talent, and they fumbled the bag, for lack of a more professional term, on their AI deployment. So Microsoft is really well positioned to take market share from Apple. Additionally, they own the entire supply chain. They own the tech, they own the software, they own Azure. We think that company is well positioned to hyperscale.
And as we look at Microsoft, they've got their earnings coming out on the 30th. What are you most interested in hearing on that earnings call, and what are your expectations?
I think we're most interested in learning about CapEx, right? This AI arms race isn't cheap, so we want to make sure that leadership is being thoughtful about the capital they're deploying, and then listening to guidance, right? Where are they positioning the company to be? But we are excited about Microsoft, and we think that Azure is going to continue to grow and take market share, and that's really why it's an overweight in our portfolios.
And I'd love to get your thoughts on something, too. I was reading a note from JP actually, today, saying that they think that Google Cloud is going to become a much stiffer competitor against Azure as they're growing at the same rate, and they're starting to encroach on Amazon as well. What are your thoughts on that?
I think it's one of those things where only time will tell. What we like about Microsoft is, again, they own the entire stack. And that's going to enable them to cross-sell and really get more engagements of their customer base across the board. Google had a strong day yesterday, but we tactically prefer Microsoft over Google in the Mag 7.
And what other companies? Anybody else in the Mag 7 you like?
Amazon, that's a name we were buying in April. Again, I think 4-day Prime Day, which might have been a little bit too much for us. I think our UPS man is tired of us, but I think that allowed them to shift over some inventory, especially post-Liberation Day, where companies were stacking up on inventory. While a competitor to Microsoft in the cloud space, we do still like diversification in our models, and we think that Amazon's going to be able to grow the distribution channel for the retail side, hopefully increase margins a little bit, and then ultimately, hopefully AWS will continue to grow at the fast clip that it's growing at.
Well, don't feel badly, Samuel. My delivery person was also very tired of me during Amazon Prime Day, and frankly, every other day too.
Well, the consumer is strong, Marley.
We're trying to be, right? We're just holding up the economy the best we can. Last question for you, Samuel, before we have to say goodbye. How are you using volatility that we're seeing this choppiness to your advantage?
Well, yeah, I mean, it's part of our core thesis. Volatility is an asset class for our portfolio construction. We're using an ETF ticker ACIO, apt as collar investment opportunity. And that collared ETF actually allows our portfolios to be positioned more towards equities because they're selling calls to buy puts to protect the downside. So they're selling index calls in there. It's more tax efficient via the ETF structure, and that allows our clients to participate more on the equity side with capped upside than just sit in fixed income and frankly rot. We need to have a real return, but we also want to manage the downside, and we're using volatility as an asset class in our models.
Well, we appreciate it so much. Thank you for all of that insight. That's Samuel Dyer Bakerly from Generation Capital Advisors.